It gives me a great pleasure to chair the last panel. When Chris asked me to chair the session, he was contributing to my aspirations to become a preeminent talk show host. I hope I'm able to do this. We have a governor, we have a president, we have a managing director and a chief economist. We could run an economy from who we have in front. I'm going to call everyone by their first names. I hope people don't mind. Really, the idea of this is, I call it wholesale exploitation. All panelists have done their bit, and we bring them back on, particularly Gita, who was just on. But the idea really is to have a fluid discussion. A lot of things have come up in the last 2 days. Not surprisingly, what Gita raised is equally relevant to what has come up. And the idea really is to give the panelists an opportunity to kind of amplify, qualify, explain in better terms some of the themes that have come up. And we hope that the conversation is fluid. We have a few themes that we want to cover, but we can take the discussions in particular directions. I will allow some time for the audience to come in. So one of the first issues that we are going to discuss is that everyone is excited about globally and in many countries having reached the peak of inflation, but there are a number of risks to the disinflation process. People are nervous. Is the disinflation process going to be sustainable? What should we guard against? So I guess I'm going to start off and ask, I'm not going to ask every panelist every question, but there's some that I'll ask every panelist to talk to. So I guess this one is something that I'm going to start off with Gita and move to the far left, ultra left of the governor. Gita, what do you see as the greatest risk to the continued disinflation path?
Yeah. So firstly, what we are, as you said, what we are seeing in many countries is headline inflation coming down quite swiftly. That's benefited from the decline in energy and food prices that we saw over the past months. Of course, with the risk that could reverse itself and we could actually see an increase in food prices, especially weather-related events like El Nino that could have an impact on food prices, that headline number could change. What we're seeing, which has more differences across countries, is when you look at core inflation, especially services inflation. We saw that come down. It has come down more gradually, and in several places it's kind of sticky at, far away from the target. So not really continuing to trend down to target. So again, in terms of risks, so in addition to shocks to weather or the war that can cause energy and food prices to again go up, you have the fact that in many countries where especially core inflation is still sticky, services sector inflation is coming down more gradually, we have tight labor markets, right? So we have labor markets with record low unemployment rates. Yes, you're seeing a softening, you're seeing vacancies coming down, but still these are robust markets. The US is an example. Resilience in consumption, consumer spending is still strong. So, we could be creating history. This could be the first time ever that inflation comes down immaculately and we don't really need much of an increase in the unemployment rate. But it always makes me nervous when you're creating history because that goes contrary to what we know. So I think that's another important risk to inflation, which is if we continue to have such resilient growth, and combined with the fact that short-term inflation expectations, like one-year ahead inflation expectations, are still significantly above central bank targets, the risk would be that combination could then de-anchor the inflation to, not an explosive level, but meaningfully above targets.
Thank you, Gita. Raphael, one of the issues in the case of the US is, the labor market. To what extent is the labor market going to continue to result in a persistence of inflation? How do you think about the upside risk of the labor market in the US?
Sure. I actually think there are two aspects to this. The first is really to be mindful that the US labor market was tight before the pandemic started. Like, this was a challenge that we had and that was putting pressure on the economy. Actually, we were actually performing quite well as a country, and there was a lot of growth, and the economic potential was understood, and we learned that it was much broader than we at first thought it might be. The thing that we've had a lot of debate about in the labor market space is to what extent does this tight labor market lead to a competition for workers, which then translates into escalating wages, which then producers will then translate into higher goods prices that they put in the marketplace, and then it just goes around and around and around. The wage price spiral that you hear people talk about. We're not seeing that right now. We do a lot of outreach to businesses to try to understand what they're thinking about and how they're thinking about their engagement with labor markets. And to date, what they are telling me is that they are increasing wages. They're doing it in some regards as a catch-up because their workers did not see the wages go up when inflation went up. When inflation went up first, so they've got to catch up to keep their workers something close to par, and that as they get closer to par, they're going to return to their price setting, wage setting to where it was pre-pandemic. So I think there's a natural arc that's happening here. We're going to have to keep an eye out, though, and the thing that I worry about, and I've worried about from the very beginning of this pandemic, is the notion of time. And the longer that people live in a higher inflation environment, there is an increased likelihood that they just get used to that environment and start to incorporate that into how they think about their investment decisions. And so, Gita talked about inflation expectations. We are tracking that very closely. I've been pleased so far that the longer run inflation expectations have not moved very much, which says to me that the American consumer, at least, is viewing this as an episodic type of experience, and one where our policies will be able to get inflation back down to its more historical level. So if we can continue to do that, if those things stay where they are, I think there's a potentially happy tale to tell. I don't use the words immaculate. I try to stay out of those things. But we're just going to try to watch, and I think that the momentum that's in so many of these economies can absorb the tightening that monetary policy has done, so that the amount of disruption to economic production can be minimized.
Thank you. One of the things you raised yesterday is your concern about a structural break in expectations, how it become more embedded. Do you think that's going to persist more? Do you think that there's a chance that you can break the inflation genie in the UK?
So I think, very similarly to what Raphael just said, we take some comfort from the fact that longer-term inflation expectations, without wanting to sound complacent, they have shown a much better degree of anchoring, reflecting, I think, some of the benefits of the inflation targeting regime in place, say, to previous episodes, the 70s and 80s in the UK, where inflation expectations did become unanchored, and that led to much more persistent and much more costly inflation episode. So that's something we have to work on. That anchoring of expectations doesn't happen by accident. It happens because of the actions of the central bank and the commitment of the central bank to its inflation target, and that commitment being operationalized in policy decisions which steer the economy back towards the monetary policy objective and retain price stability. I think what's important to understand about the UK economy is that it reflects both of the comments here. We also entered the episode of the pandemic with a relatively tight labor market. Some of the consequences of the pandemic in terms of their impact on labor supply accentuated the tightness of the labor market at a time when we were also being confronted with a very significant inflationary impulse, and crucially also a very significant deterioration of the terms of trade associated with the rise in energy prices and in food prices and in international goods prices, all of which are things that the UK is a big net importer of. So I think that the challenge in the UK is that this catch-up process is not just a catch-up process in the face of some inflationary dynamic, it's also a catch-up process because national income has been squeezed by the impact of the deterioration in the terms of trade. So it's the cross of a tight labour market with this pressure to catch up. The interaction of those two things create a context where I think the Bank of England, the MPC, has to be particularly cautious, particularly wary of allowing a dynamic to emerge that leads to persistence. And I think that's kind of where our efforts have been and why maybe we are yet to see the downturn in core inflation, the downturn in services price inflation that we need to see to be reassured that we're going to get back to target in a timely manner. Thank you.
Pretend for this purposes that the governor is not my boss and I'm not reporting just for this panel. Lesetja, given the quintessential emerging market where inflation expectations are not that anchored, the exchange rate is always an issue, what are your concerns about the upside risk to inflation, to the disinflation process at the moment?
Well, I have the disadvantage that I have not been a panelist in the past days, so they are all one up on me. I think that for a small open economy like us, the risks coming through the exchange rate channel will always be there. And as policy tightens or remaining tight for longer in the advanced economies, it has got implications for exchange rate dynamics, and we've got to be watching that. It had been even clearer in the case of food prices because we know that food prices in dollar terms had come down rapidly, and they remained sticky in rand terms for a protracted period of time, and it's only just dipped below at 10%, and that is reflective of the exchange rate dynamics. And in a way, when one thinks then about that, and you look at what had been happening to inflation expectations, for a long time it's almost like, yes, the surveyed expectations, this is what they are telling us, and as economists, we would like to think that the price setters are rational and they are forward-looking. But expectations in South Africa are very much adaptive. And so in 2021, when inflation had declined significantly from 2020, what we actually saw was that inflation expectations were actually roughly where inflation was, and you asked from the surveys, that is what they were seeing over the next 2 years, continuing on that trajectory. So they are very much adaptive. Of late, the most recent print in inflation is 4.7. Inflation expectations are still very much elevated, and I expect that they would revert. And the reason they would revert is precisely because they are very much adaptive, and they see the most recent figure coming on like that. I think that one more word is that the season is changing, but seeing one swallow arrive does not mean that summer is here. Okay, so the most recent figure is 4.7. And there is all sorts of excitement that, oh, finally we have conquered this monster that is inflation. And I think that my message is the job is not done. We've got to be seeing that inflation is on a downward trajectory, but importantly, we have got to see inflation expectations coming down and getting anchored to where we would like to see them. Just to round it off, that the risks to intelligence on the global side for us is through the exchange rate, the uncertainty with respect to the oil price, and then of course domestically we have got our own idiosyncrasies, the impact of load shedding, which we had always thought of it as an impact on economic activity. There are indications that it is having an effect on inflation. by how much it is something that the clever men and women in the research department have been trying to grapple with, can't quite get their arms around it. But those for me would be what the risks that we are going to have to watch closely.
Thank you. One of the risks we've been talking about in the last 2 days, it's a recurring theme in the BIS in many places, is how do we as central banks think about fiscal risks? And there's a voluminous rich literature on how you think about the challenges of fiscal risks to monetary policy. The debates have changed, they've evolved. One thing that Raphael raised yesterday is that in some ways, emerging markets is a bit of an artificial term. In other ways, there's logical why you have a group of countries you designate as emerging markets. I guess, is the risk to fiscal risks to central banking or monetary policy in an emerging market very different from that of a developed country, particularly when you're issuing your own convertible currencies, you're relying less on bond markets. And so that's something that I want to raise, and I want to start off with Lesetja, move around, is how do you think of fiscal risks as the governor of the central bank today, given our own fiscal risks?
I hoped that you would give that question to the others, so that I can stay away from it. But let's take it this way. Firstly, is that treasuries have got to be weaned. They had become addicted to cheap money and are behaving as if they are richer than they actually are. And so treasuries globally have binged on debt because the central banks created an enemy of themselves, calling themselves the only game in town, and so engaged in interesting measures that suppressed bond yields, and in that process, the necessary reforms that were supposed to take place from the fiscal side and from the structural side got postponed. And so the pandemic set in, and natural response was that we have got to act counter-cyclically. And treasuries did act counter-cyclically, globally, including our very own here. The central bank also acted counter-cyclically. And we had to take extraordinary measures because we were responding to a shock. Those measures were taken during a wartime, and they had to be taken off. So what did the central banks do? I mean, in our case, we had embarked on some bond purchase, and we were very clear, and Raphael pointed out this thing, we were very clear, we were dealing with a market dysfunction. As you have heard from the previous panel, the treasuries got addicted to it, and now they think we must be in the primary market because now they are looking for cheap money. And so you have that. And you have had support extended to households, not just here, elsewhere. When this support has to be taken off because it was meant to be temporary, there is a reluctance to do that. And so it becomes a very difficult process to think about that. Now, just to close this off, that Gita earlier on talked about R-star and about how R-star, even if it was to decline, would not decline to the pre-pandemic levels. And I share that view. And for emerging market economies, with fiscal metrics that are worse than what they were prior to the pandemic, they are going to be faced with elevated risk premium. And we are actually seeing that, and I think that it was Atif yesterday in his thing when he talked about the uniqueness of emerging markets and the impact of fiscal through that becomes important. And if you decompose South African ARSA, you will find that the biggest component that had been driving the rise in ARSA had been the country risk premium. And that's how I would think about fiscal policy. I'm sure if you were to put treasuries together in one room without the central banks, they will say pretty nasty things about central banks too.
Thank you. Thank you. You've been a member of the MPC. You couldn't avoid thinking about fiscal policy and how it has a bearing on your monetary policy decisions. How have you thought about it in the last?
Well, I mean, what you say is very much right. I should say I very much agree with your comments on addiction and so forth. I think we are in a process of normalization, and that's going to be a challenging process, and we're not complete in that process yet. But I did want to pick up on your question, and one of the themes has been, is there a distinction between emerging markets and developed markets? And more or less this time last year, we had an episode in the UK, which I did refer to yesterday, where a fiscal measure led to some turmoil and dislocation and dysfunction in financial markets. And you used earlier this very vivid picture of the dangers of central bankers swimming with crocodiles. I think that episode, felt like we were by a river with lots of crocodiles in, and we were dipping our toe into that river, which was not a comfortable experience. And I think what was sort of crucial about that, and maybe is an issue about whether this distinction between emerging and developed markets exists and how it can be thought about, is that what was crucial, I think, in that episode was that the institutional structure, which was intended to ensure, and I think over a long period has ensured, a good order in the overall macroeconomic framework in the UK. One key part of which, clearly the inflation target is part of that, fiscal rules are part of that, but one key part of that was the existence of this Office for Budget Responsibility, an independent fiscal authority which played a key role in ensuring and signaling where there was a threat to longer-term fiscal stability. And that episode was one where that organization, that institution was cut out, and I think brought into question the wider institutional structure within which macroeconomic policy in general, including monetary policy, operated. And I think it's that respect for institutions, well-designed institutions that have proved their worth. If we get to a situation where those institutions are put into question, that can be a very destabilizing thing. So it seems to me is that respect for institutions, you need to build and develop those institutions. That may be the challenge in many emerging markets. The challenge in developed markets may be having hopefully built the right institutions, ensuring that the political process respects them.
Raphael, in your context, the US thinking about fiscal challenges as you make monetary policy?
So the dynamic is very similar. Like, cheap is cheap. And when something's cheap, people run to it. And that's just sort of a natural feature of, I think, human nature. And as we've tried to normalize, I very much agree with the governor's perspective. Like, in an emergency, you do what you have to do. You do emergency measures. But at some point, you've got to take them away when the emergency is passed and then get back to a more normal space. Now, we had a cascade of emergencies. So the great financial crisis was a huge emergency. In the US, we were actually starting to normalize in 2019 to try to get off of that. We saw dysfunction in our financial markets, so we had to back off of that. Then the pandemic happened, which is another emergency on top of that. And it led to basically a decade of very low cost of debt. We're going to try, we've done a better job at normalizing in this recent episode. And inflation kind of woke us up in that to make sure that we had to be resolute to make sure that everybody understood that we did still remember our mandate, and we took that seriously. And now it will be for all the other institutions out there to have to remember what it's like to be in a more normal environment. I said yesterday, so many bankers in our country have never lived in a rising interest rate environment or a higher interest rate environment. They've never done it. And so there's a lot of learning that needs to take place. And moreover, we have a lot of existing debt out there that is at very low prices. And when that comes due, they're not going to be able to refinance into comparable prices. There's going to be an adjustment that needs to happen on that. So I actually think there's a shaking out that's about to happen at all levels. And in the U.S., we're starting to hear more conversations about the public debt, because that's another one, the government debt. The amount of interest that's going to be paid on that debt is going up considerably. So there's pressure that's going to happen in all of these areas, and it will be for businesses, for families, and for public sector institutions to find new pathways forward given this new reality, and that will be something that we will then have to take on board and think about how our policy trajectory needs to play out in the coming quarters.
Thank you. Gita, there are a few ways in which we for example, in a country like South Africa, think about fiscal risks. If the risk premium goes up, we think that has a negative effect on our exchange rate, and the transmission mechanism is that a depreciated exchange rate may lead to more inflation, and in that sense, the fiscal risks prevent us from being looser than we think we could have been otherwise. Do you think those mechanisms make sense? Do they work differently in some of the countries you look at, like the more developed countries, relative to, say, an emerging market?
Yeah, I do think that the impacts of fiscal risks on monetary policy do work differently. An important factor is what you said, which is the institutions that back these frameworks are different. So the analysis we've done, for instance, shows, for one, if you look at emerging and developing economies, when debt levels go high, they do affect long-term inflation expectations, something we don't see for developed markets, right? So increasing high levels of fiscal debt affects long-term inflation expectations, which then, of course, it makes the task for central banks much harder. It's a much difficult problem to deal with. The second thing that you see differently between developed and emerging markets is that, there used to be the sense of there is tremendous fear of floating in emerging markets because of which they don't behave in a countercyclical manner. But if you actually look at over the last couple of decades, emerging markets central banks behave actually quite similar to what developed market central banks do. So if you estimate Taylor rules, or you estimate what is the response to inflation going up or output going up, it looks classically like what a developed market central banker does. The problem, of course, is what happens to the market rates, what happens to the money market rate, what happens to the treasury rate, right? And that's the transmission channel you talked about. There, in developed markets, those things move very closely. The policy rate, the money market rates, the T-bill rates go hand in hand. But in emerging markets and developing economies, you actually have episodes when they go in opposite directions, which is that the central bank cuts rates, but money market rates go up and treasury rates go up because at the same time, fiscal risk is building up and risk premia are going up. And so the transmission channel really gets affected, right? So in that environment, when governments insist on central banks cutting rates, in a sense, that is not the problem. The problem is the fiscal risk that is causing premias to go up, and in addition to what you said, which is on exchange rate risk too. These are two ways in which advanced economies differ from emerging markets. And there is, everybody, of course, has the impact on our star of debt going up. I think that's universally true.
Yeah, so thank you very much for that. I'm going to ask different questions to different panel members and then open it up. You talked in your speech about our star. How should we, one important part of our star is what happened to fiscal policy. But how should we think about our star? You mentioned that it could come back, maybe not to the levels we thought about. Do you think that the drivers of our star have changed, if not radically, in some nuanced ways, as a result of the pandemic or just changes in the structures of the different economies?
Yeah, so we know, of course, as the IMF, we study this very carefully, and we looked at what drove the decline in R star, and therefore what do we think might happen going forward. There are two global factors that seem to be fairly strong drivers of the R star, the decline in the R star were one, aging demographics, and the second is low productivity growth. A third factor is the concentration of wealth inequality, which led to this huge amount of cash that could then be parked in safe assets. So looking ahead, I guess the question is what changes, right? We do expect that aging demographics is combined with longevity because people are living longer. And as of now, our prediction for productivity growth, which is again on the lower level, are factors that suggest that we may head in the direction of the pre-pandemic rates. The factors that offset that are the level of debt, which is very high. But it's not just the level of debt that we have now, but the projected part of debt that we have for many countries. So we're seeing that way in the opposite direction. And there are big spending needs, like I said. If climate adaptation and mitigation is done entirely through budgetary spending, borrowing, which a lot of countries are hoping to rely on, the projected debt increases are really large. I mean, I gave you the number for emerging markets, but for advanced economies too, it's very large. So if we're heading in that world, then we are moving, that would be a higher R star. Then there is the question of geoeconomic fragmentation and what that can do to R star. And there is it's mixed because you want to look at the effect on savings versus investment. On the one hand, geoeconomic fragmentation has a tendency to lower output, global output. That's negative for savings. But on the other hand, it also weakens productivity, reduces the demand for investment too. So the net effect depends upon which is stronger than the other, and we've run simulations to see where that is. So it's not a very clear story that comes out of it. But again, for me, the risks that come from growing debt and the large spending needs coming up are what could move us away from the kinds of very low R stars that we had before.
Lesetja, it turns out that you talked about fiscal risk, you're chair of the Monetary Policy Committee, but you also happen to be chair of the Financial Stability Committee. And given all the risk the Monetary Policy Committee has been facing, how have you, as chair of this committee, thought of trade-offs between financial stability and monetary policy? Has it affected the way you've thought about monetary policy?
I have regular meetings with the chair of the Financial Stability Committee. Look, yeah, I mean, you said trade-offs, and I actually do not see the trade-offs between financial stability and mandate and the price stability mandate. They actually very much complicate each other. It is in the execution of the monetary policy that things come in, and it is very important why financial stability has to be inside the central bank, because you get to see the other side, and I'm sure Raphael will talk about what they had seen with the mid-sized banks and what as policy changed. And one of the things that we ended up having to think about this had to do with the sovereign banking nexus, because that's how we have got to think about it. And so in 2020, in the middle of the pandemic, we also got downgraded. We fell out of key indices, and as a result, we had massive capital outflows. Somebody had to pick up that tab. It was the South African banks, not always very popular, but they came to the party. They came to the party and they picked up the bonds, and government continued to be funded. And of course, as policy now normalizes, they are sitting with these bonds. And our work showed that the big banks were sort of like, okay, you could mark these things to the market, they were accounting for it, they were okay. But when you start to look lower down, where also the accounting treatment is different, because the smaller banks would tend to say they are holding these bonds to maturity, suddenly they sit with the losses, but because they are just saying they are holding these things to maturity, they do not have to worry about it. But from a financial stability perspective, you then start to worry about it. And so you have that nexus. And the correct way then of having to deal with it, if the crocodiles were to listen, would have been that the thing to do is that fiscal would have had to be more constrained, because then failure to do so has got financial stability implications in that respect. And so because the borrowing is increasing, the bond yields are going up, and the holders of the bonds are facing mark-to-market losses. And so you end up having to think of it in that manner. Just one last thing, and then I will go. You know, I'm enjoying this panel. But you see, I must also say, central bankers, we also have another problem. We talk to ourselves. There are other people watching and listening there. They don't know what R-star is. And in central bank communication, the stars are not very useful in communicating the messages, because they are unobservable, are not understood. So for the benefits of those who will be writing for the South African public tomorrow, that R-star is simply that interest rate at which monetary policy is neither expansionary nor contractionary. So I just thought I would plant that.
Raphael, the SVB saga and so on was made for interesting conversation in the Federal Reserve Committee. Monetary policy and financial stability seem to be at the crossroads. Interest rate risk became the number one destabilizer. How did you guys think about this?
All right, so I'm going to jump on the governor here at Silicon Valley Bank, SVB. So in my bank, I hate acronyms. I try never to use them, because depending on your background, the same acronym means different things, and no one knows what you're talking about. What I would say is this. There's always been a nexus between monetary policy and financial stability. They don't necessarily need to be trade-offs, but when monetary policy moves, those who are responsible for institutional stability actually have to move as well. And there are established ways that those movements should happen. And what we saw in the Silicon Valley Bank situation, in the First Republic situation, to Signature Bank, we had a number of these institutions where risk management was not very good, where the teams did not really take on board the seriousness of some types of risks that were well known. You know, one of the things that has struck me through this whole thing is that there were no new risks here. This wasn't like the Great Financial Crisis, when you had a bunch of new facilities and new tools and types of investment instruments. This was bread and butter stuff. This interest rate risk, liquidity risk, like these are things that are in basic finance textbooks. And I think that reality caused people to think that that was not enough. Because it was so well known, there was no chance that those things could be deadly. And that turned out to be wrong. So to me, what we've started to do is so when this happened, we called every bank in our district and basically said, how are you managing your risk? Do you understand what's happening? Do you know what kind of facilities are available to you as safeguards? So, we have the discount window in the US, which is supposed to allow us to be lender of last resort in crises. And what we learned is that there were a number of banks in our country who didn't know how to use it. They were not prepared, and that exacerbated the challenge. And so readiness has become something that has been paramount to us in terms of, our institutions, but also internal to us, because the other thing that, when I think about our deposit insurance system, we designed our deposit insurance with the notion that runs only happen by families and households, and that business deposits are largely stickier than what happens for families. And that turns out today to not be true. Now, I don't think it probably wasn't true then either, but we didn't really test it, and the technology wasn't such that that was a material thing to have to worry about. But today, when you can move money, like on your phone, you all could just decide to collectively move your money right now. Please don't do that. We want capital to stay where it is. But that is a material change, and that happened through innovations that were kind of not in banking. They were more in like the sort of a digitalization of the world, payments, all that kind of stuff. But it wound up having really big implications for how tenuous deposits and other sources of capital could be. Those are things we're going to have to take on board. But this episode was really about execution and risk management, and then on top of it, appropriate supervision and to make sure you're having the right conversations in the right time, so that you avoid the worst of the outcomes. And we're going to have to revise basically all of our policies and processes given this new reality.
Thank you. I want to cover one more theme, a slightly different topic with you that emerged in this conference, and then we can open it up. Just to build on what you said yesterday, how does the transmission mechanism change? Are the variables and the lags, do those change? Do the coefficients of 1% rise in interest rate impact on GDP or inflation? Does that change in different times? How have you thought about this recently?
Could I just make one comment on financial stability and monetary policy? And I'm just echoing something I also said yesterday, which is I think the UK experience does demonstrate that it is important from an overall financial stability perspective not to focus just exclusively on the banks. So that the increase in size and importance of the non-bank financial institution sector and the potential actually for risks in the post-financial crisis environment to being shifted from the banking sector into the non-bank financial institution sector does raise some issues. I very much agree with the point, which actually both Raphael and the Governor have made, that there are many complementarities between financial stability and monetary policy. And in particular, coming to your point a little bit, a well-functioning financial system is one that transmits monetary policy effectively, and a monetary policy that effectively establishes price stability is something that creates an environment that's supportive to financial stability. What I think we saw during this episode I've already mentioned last year was the threat of a more operational concern, where dysfunction in markets created by the sort of phenomena I was describing, not really a monetary phenomenon at all, but a dysfunction that emerged, required quite temporary and targeted interventions in markets to try and stabilize and improve market functioning, which was definitely supportive of monetary policy. But that occurred at a time when we were seeking to implement our quantitative tightening program and sell government bonds. So there was an operational tension there. In the end, signaling clearly these were two different processes, I think things worked out remarkably well in what was a difficult environment. So I think it's more an operational issue rather than a sort of substantive conceptual issue. But then coming to your point about monetary policy transmission, so I showed yesterday a chart, or a set of charts, illustrating how we view monetary policy transmission estimated on data up to 2019, and it has all the characteristics one would like, as I said. Now, the bad part of that story is if you extend that estimation up to 2023, a lot of that behavior becomes much more unstable, much more uncertain. Now, of course, the pandemic episode, you may want to dummy out. That's a very exceptional episode. We saw demand and supply move in very significant directions, literally off the scale in terms of historical experience. But what's slightly more worrying is even if you dummy that out, but you extend the estimation just with the couple of years of sort of post-pandemic data we have, you still see quite a lot of instability. And that goes very much to your first question, or at least part of it does, is in terms of questions like what is the slope of the Phillips curve, or in other words, recognizing your point about communication, how sensitive are wages and prices to developments in costs and developments in employment, unemployment, and activity. I think there are open questions in that context, and that's where acting in a way to stabilize inflation and ensure we go back to target is so crucial from the Bank of England and MPC's point of view. I think there are, of course, always changes going on in the structure of the financial system. The rise of the non-bank financial sector is one part of that. We haven't really changed policy rates, at least in the UK, for a very long period. So testing how these changes in financial structure work is something that is inevitably a little bit of a real-time exercise. And we do a lot of work to try and understand in depth that. One of the things I would have said yesterday is just to recognize that there have been changes, for example, in the structure of mortgage markets in the UK. We've seen a lengthening of the maturity of interest rate fixation in mortgages. 20 years ago, most UK mortgages were indexed to the policy rate directly. Now most mortgages are fixed at least for 2 to 5 years. So prima facie, that would suggest the transmission of policy rates into a key element of how the UK economy is affected, how demand is affected in the economy could change. And I think there is a danger that because we have a lot of information on mortgages, we collect data on every single mortgage in the UK, that we become a little bit focused on that specific aspect. Whereas I think I'll look at aggregate transmission, taking into account the impact of changes of interest rates on other parts, including residential investment, corporate investment, and so forth, perhaps suggest that there are fewer changes. So at least at the moment, our overall view is at the aggregate macro level, transmission has not changed that much, although the relative importance of different channels within transmission may have changed.
Okay, thank you very much. It's time to open it up to questions. So what we're going to do is take a few questions, one round of a few questions, and then give the panel a final opportunity to come back. Keep it sweet and short. Who's going to kick off? Okay, we have one there and we have one there. Yeah. Please introduce yourself, state where you are from. Jeff, yeah, I think it's you. Yeah. Go for it.
Yes, thank you, Chair. Jean-François Mercier from the Reserve Bank. I want to follow up a bit on this issue about that Gita Gopinath was talking about, about the tighter financial conditions, the fact that R-star might not be as low, and just talk about higher short-term R-star, the fact that policy might be on the higher side rather than on the lower side more often, that bond yield curves might be steeper. Isn't there some potential benefit in having real interest rates that are a bit more in line with what we used to know like 20, 30, 40 years ago, in the sense that it might wean off a little bit both the public and private sector from debt addiction, not just force fiscal policymakers to be more responsible, but maybe force companies to seek higher productivity gains rather than just rely on cheap capital, because cheap capital costs can mean cheap returns on capital, low productivity. Isn't there therefore a silver lining in have a higher real interest rates?
In front, Anna.
Thanks very much. Arnab Das from Invesco. I sort of agree with this view that you have, for what it's worth, on R-star, but I'm struck by John Williams and Olivier Blanchard suggesting that it's quite conclusively the case that we're going back to a very low rate environment. The natural rate hasn't really changed. So I wanted to ask you all to kind of opine on that, and what would make that make us go back to that low for long kind of environment, generally global R-star and in each of the individual economies. Thank you.
Anyone else? At the back there. Yep.
Good afternoon, my name is Marianne Telm. I have a question please for Gita. In your work at the IMF, particularly during the pandemic and then afterwards, you advocated very strongly for a broader discussion or perhaps even a framework within which to assist emerging markets with increasingly fragile fiscal positions, which were perhaps becoming increasingly vulnerable and were likely to be perhaps unsustainable coming out of the recession with a big accumulation of debt. You identified South Africa's enormous fiscal interest burden, debt service burden in your presentation, and those numbers, I think, probably particularly from your perspective, are frankly quite alarming. I just wondered from your perspective what recommendation you would make to South Africa. We've heard lots of suggestions during the course of the last few days to reducing this interest burden, recognizing perhaps that there is a potential urgency to this challenge. Thank you.
One more question, and then we close. There, right side. Yep.
Thank you very much. It was a throwaway comment by Huw Pill about financial risks having moved out of the banking sector. Can I just get a sense of why we should be worried about that?
Okay, so questions on tighter financial conditions, R-star going back to lower rates, IMF assistance on fiscal fragility, and the last question. Gita, do you want to kick off on any?
Yeah, thank you. On R-star going up, so I think firstly, for the longest time, central banks have been hoping that they can actually have the R-star go up because then that gives them some more leeway if there is a recession to be able to cut rates, and there's more space for that to happen. The question is what drives the R-star up? If it is coming from higher productivity growth, then that's a win-win. That's great. That's higher investment, higher R-star, that's fine. The problem is if that higher R-star comes from very large amounts of government debt that are reducing the convenience yields on safe assets and therefore has spillovers to other kinds of riskier assets and so on. I think that those are the kinds of increases that could be somewhat more problematic. To where R-star is headed, just to be clear, like I said, there are two factors, which is aging demographics, and as of now, our prediction for productivity growth makes returning to levels of R-star, which are closer to the pre-pandemic level, may not be exactly the pre-pandemic level, but closer to it, a very real possibility. So that is a real possibility. But I think that the risks that we could have debt going up by a lot more, especially given the spending needs that exist, and given the approach that many governments are taking in advanced economies to rely a lot on basically borrowing to finance it, for instance, the climate transition. Those are the kinds of events in which we could see that's where the risk, for instance, of R-star going up. And like I said, in a sense, even if R-star comes fairly close back down to pre-pandemic levels, I don't believe we're returning to the era of low for long for the reasons that I mentioned, because I think we're going to be in an environment that's much more volatile, supply shocks, many more adverse supply shocks. I think central bankers are going to be a little more wary of keeping rates too long when your inflation is, say, 1.5% as opposed to 2%. So I think that for all those reasons, we might be moving to a higher interest rate environment. Lastly, to your question on fiscal and what needs to be done, I mean, in the case of South Africa, I mean, our advice is, we put this in our Article 4 for South Africa, which is we do need fiscal consolidation to happen. At present, the numbers I gave you in terms of interest costs, if you end up in 2028 with 27% of your of your revenue basically being used to make interest payments, that is really not good. So we would urge for fiscal consolidations to put debt on a downward path. And where are the spaces where we think that can be done? One is in terms of containing the increase in wage bills. The second is in terms of containing the transfers to state-owned enterprises, and that can be done, and you see some progress happening on that front. What we do see, I mean, if you look at countries more generally and look at what it takes to bring debt to GDP down, fiscal consolidations sometimes don't always deliver because it can negatively affect your GDP level, and so therefore you end up with debt to GDP not coming down. Therefore, when you do fiscal consolidation, if it goes along with structural reforms, which in the case of South Africa would be reforms to the energy sector, to the transport sector, through reducing crime, through raising the quality of education and so on, it's in those episodes that you see a fiscal consolidation that's successful in being able to reduce debt to GDP.
Thank you. Lesetja, anything you want to respond to?
No, not much, but I just want to bring something to the forth, which it's coming through here as people talk about rising interest burden. And there was even a subtext in the previous panel that if you have got rising debt service costs, the solution is to get cheap debt. That is not the solution. There is one thing debt managers control. They do not control the price at which they borrow. There's only one thing they control, is the amount of debt they issue. And if you want to bring down the debt burden, the interest burden, you are going to have to reduce what you are actually borrowing. This becomes important because but when Gita talked about the reduction in the convenience yield, is that absent that consolidation, the cost of borrowing for government remains elevated, and such will also be the case across the economy, one. And two, that the risk premium will remain elevated and it feeds into the neutral real rate for us, which would then mean that we are in all sorts of problems. But, you know, Gita, I'm going to throw this back to you because you'll have a better database than I do. So this is how the South African narrative goes. R is is bigger than G. And because R is bigger than G, the only way out of our problems is that we must raise G. We do not have to do anything with R. And we know that R is a function of what we were just talking about the risks. And the question that comes is, show me one country in the world that had ever solved that problem without raising G. And, I mean, you've got 189 members. I'm sure you, amongst those members, you might have found countries that have grown their way out of debt.
As you can see, the governor took my job. He's now the panel of...
Just very quickly, it is the case, the growth helps absolutely in reducing debt to GDP. But of course, in the case of a country like South Africa, where we have projected debt trajectories which are just rising over time and interest burdens are rising over time, it's absolutely essential to put that debt trajectory on a downward path, and therefore actions on the fiscal front to rein in the kinds of spending that happens is critical.
You, anything? There was a question for you?
I mean, just very brief on the question.
Mike.
Oh, what am I doing? Sorry. I have the karaoke mic, so as long as you're not expecting me to sing, it's okay. So I don't think there's anything specific about having risks in the banking system or not in the banking system, but wherever the risks lie, I think they have to be well managed, and I think that's the challenge. As risks have migrated out of the banking system, we know a lot of effort was made following the global financial crisis to improve the capitalization and regulation within the banking system. And so the issue is, and I think we've had experiences, not least in the UK a year ago, where there have been issues that have arisen because of some opacity in the non-bank financial institution sector. I just also want to echo, I think, on the first questions about R-star, I think what Gita said is right. It's important to emphasize, the issue really is why R-star is higher. There are good reasons and bad reasons, and we should aim for the good reasons. The only thing I would add is, from the perspective of someone who is making decisions about interest rates on a 6-weekly basis, R-star is, in principle, a very useful thing to know. But in practice, it doesn't help us very much, because we'll only really know the answer to all the questions about whether R-star is higher or lower, and whether it's higher or lower for good or bad reasons, when we look back at this experience in 20 years' time. So I'd be cautious about saying we can come up with estimates of R-star which should be the drivers of our current decisions. I think the drivers of our current decisions have to be much more focused on how we see the outlook for inflation at the 2 to 3 year horizon.
I totally agree with Hugh's last point. I do think there are reasons why we might see R-star rise, though. One is, in the United States, a very interesting thing happened in that many businesses that have been contemplating introducing technologies started to do it. They saw the pandemic as an opportunity to like step back and start to implement a bunch of things that had been on the table, but they had been too busy and running around to try to figure those things out. And so there's been an infusion of a lot of new things. So I was at a restaurant like 2 weeks ago, and a robot brought me my food. Right, and I had never seen this before, but this is a way that businesses are trying to increase their productivity while providing services, and I have a sense that, at least in our country, that's going to happen more often. The other thing I would say on our star is the amount of uncertainty that exists in the world that translates to risk just feels higher to me. I'll just say, 10 years ago, I thought I understood what the boundaries of possible events were going to be or could be. And all my boundaries got blown up, right? Things like war in Europe never was, just was not on my list. I get a question often when I go out and talk, like, what are the top 3 things that are keeping you up at night? And what I've been telling people recently is everything. I don't have a top 3 list, mainly because a year, like 2 months before an invasion in Russia, an invasion in Ukraine was not on my list. 2 months before a global pandemic was not on my list, right? And so having a list, I just threw the list away. Like there's nothing on the list because the range of things that could happen is just in a real way gone far beyond what I could think about. And with more uncertainty than the premium to having your money somewhere else over a long period of time is just going to go up, which should drive up interest rates. So I think that is out there, and that's a real thing. On the non-bank question, you said the word opacity. That's the issue for me in the sense that risks can shuffle around. That's fine as long as we can see them. But we have a whole regulatory structure that allows us to have clear sightlines on the risks that exist in the banking sector. When it goes to non-banks, those kind of infrastructures don't exist. So it is much more difficult for us to have an appreciation for what the nature of those risks are, to have any idea about whether there's appropriate risk management going on at those institutions. And that is a challenge. And then the other part that makes it even more complicated is that many non-banks have backdoor connections to banks, and that we also don't always have good sightlines on. And so that interconnectivity means that the types of exposures that you might have could result in an amplification of transmission of risk through our institutions in ways that are going to be a surprise. And so the more that we depend on the non-banks, to me it says the more effort we've got to make to understand those institutions, get the clarity on that, and it's actually a new type of activity that we're all going to have to invest in a lot more.
Okay, I think we're going to call it a day. Let me thank the panel for a fantastic discussion. I guess it's, on behalf of the governor and my colleagues Kuben and Fundi, it's just appropriate to thank firstly the SARB, and particularly Chris Luvalt and his team, Constantine, Ketiwe, Tuli, Thureya and the communications team and the logistics team for organizing a fantastic conference, the Cape Town Convention Center, and more importantly, the speakers, the participants, and for those who've come all the way to the tip of the African continent. Thank you for coming, and we really appreciate your visit to South Africa. So thank you, everyone. We're done. Lunch is served next door in the adjacent hall. Thank you very much. I hope you get some time to see a bit of Cape Town.